Welcome back, everybody. Doug Burson, CPA, and today we're going to go through the big tax bill that just passed the House. Now, obviously, it's just gone through the House, so that doesn't mean this is final, but there's some really good things in here, at least from a taxpayer perspective, and I want to make sure you know what they are. We'll go through them line by line. Hopefully this one doesn't take too long. If it gets too long, we'll break it into two, but I think we can get through it pretty quick and give you at least a feel for it. We won't go super deep. I just want to make it understandable. That's my goal, is to make it so you understand what's coming and you can plan appropriately. So with that, let's go ahead and get started. Okay, so a big part of this bill is really based on the original Trump bill that passed back in 2018, I believe it was, the Tax Cuts and Jobs Act. And most of this is going to be based on that, and this is a really big win for a lot of us who are either business owners or families as far as that goes, because there's a lot of things in that bill that helped all across the gamut. But there's quite a few changes in here too, and so I want to make sure you understand at least where this is headed. I'm going to talk about a few things that I think are probably pretty solid, talk about some things that I think may not make it all the way through or some changes, and help you get ahead of this. And then we'll be watching, of course, when it actually gets through the Senate, because there's going to be several changes, and then I'll go a little deeper on that. But this one, I just want you to know what's going on and make sure you're up to date. So with that, let's go ahead and dive right in. First thing are the tax brackets. All right, so currently there's 7 different brackets. So there's not going to be a real big change here. If this bill passes, those brackets are going to stay the same. Well, not this bill, there'll be changes, but you know what I mean. If this gets all the way through the Senate, the brackets will stay the same, going from 10% all the way up to 37%, 7 different brackets. But if it didn't, this was all set to expire, and our rates would be going up, and they would go from 10 all the way up to 39.6. But the difference is not just the amount, but the width of them too. So this is a really big win if this gets through for us as taxpayers, and so that's exciting to see. CBO, they actually estimate that this alone is going to cost $2.2 trillion. Now, why does this matter? This bill has to go through reconciliation to get all the way through, passed, and signed. So to do everything, it has to work. And so how much these things cost are going to have an impact. This particular part, I think, will stay, and I want to go through that for each section. Here's what I think will happen. Here's what I don't. But I think that part will go ahead. But let's move on to the next one. The next one is the standard deduction. If you remember, used to the standard deduction was a lot lower. But back in 2018, they almost doubled the rates. It was $12,000 for an individual, $18,000 for a head of household, and $24,000 for married filing joint. Now, and those have been indexed and been going forward. So for 25, we're set to go $15,000 individual, $22,500 for head of household, and $30,000. That expires the end of this year. So next year, 2026, those numbers would plummet and go back to the pre-TCJA, which is the Tax Cuts Act from 18. They'd go back to the pre-TCJA amounts and get indexed forward. That would be a big hit for a lot of people, because if you 2018, that would have been $6,500 for single, not 12, $9,550 for head of household, not 18, and 13 for married filing joint, not 24. So almost right down the middle, 50%. That would be a major hit on the tax deduction. Right now, CBA estimates that to be a $1.3 trillion hit to make this thing budget. But this is also one that I think we can actually bank on happening. So I think that's the way that one's going to go. And the interesting part about this is if this bill happens, they're going to make that permanent. They want to make that permanent. And that's a big deal, because a lot of these bills, what they do is they say they're going to be X, but then after so many years, it expires and reverts back. They're trying to make this one permanent so then we just index for inflation, and that makes planning a whole lot easier. And so I think that could be a good thing, at least from a tax side. I'm not getting into politics. I'm just talking about us, you, me, business owners, taxpayers. If this is a benefit to us, and that's what we're going to talk about, that would be good for us. All right, another one there is the personal dependency exemption. If you remember, the standard deduction was a lot lower back then. We just talked about that. But we also got a dependency exemption, an amount that you got to deduct for each person. That was set to expire at the end of this year, and we would go back to the dependency exemption. Right now in the bill, that's going to go away, and I think that'll stay. I think we can plan on that one not going anywhere. Okay, next child tax credit. If you have kids, this one's a big one. If you remember back in 2017, back then we were only getting $1,000 per kid. This bill came out, the Tax Cuts and Jobs Act, TCJA, and it went to $2,000. And that's been really nice, but that is also set to expire. And if this doesn't get fixed, next year we go back to $1,000. This new bill addresses that, and not only does it address it, it improves it. So right now, they've got it scheduled to go from $2,000 to $2,500, but that would only be through 28. Remember, they got to make this thing work, so they're going to take a little, give a little. This is one where they're set it up to go through 2028. Will that one happen? That one's going to be interesting. We're going to have to watch because there's people who want it to go all the way up to somewhere around 3,000 to 5,000. This one could still be in play, so I don't know exactly what that number is going to be. I do anticipate it will go up, and we're just going to have to watch and see what happens in the Senate, and I'll keep you informed. But that one we're going to have to watch. Next one I got on my list is moving expenses. A lot of you remember that back if you moved and you moved far enough from your main home and your new job and you had to do all the calculations, we could actually deduct a lot of our moving expenses. Well, with the TCJA, that went away unless it was for military. That is set to expire. They've basically got this new bill set to mirror, which is so many things in here. They're pretty much mirroring the original TCJA Act of 2018. Simple answer what that means is, for most of us, tax rules will stay the same for the most part, but there are a few things that could be interesting, that could be helpful. You know, that's why we're going through all this. But for moving, as of now, I anticipate that it's going to stay the same way it is, and moving expenses will still not be deductible. That's how it is in the current House bill. I don't see that one changing. So that one, I don't think we're going to get moving expenses back, and so let's keep going. Another one that's on there is the increase in charitable deductions, where you could go from 50 to 60%. So what does that mean? That means you could give up to 50 to 60% of your adjusted gross income. That is set to expire. I don't see any reason that they're going to push to get that one back. If there's somewhere you can maybe claw a little money back to fund something else, that's this one. Is currently not in the House bill. I think that's going to drop back to 50. I'll be honest, not many of my clients are able to donate more than half of their income in a given year anyway. There are times, and I understand that, but as a general rule, that one's not going to garner enough support. I think that one goes away and stays how it is in the House bill. Okay, this other one, this one's a big deal. This one is the SALT tax. And SALT tax simply means state and local tax. That's what SALT is, state and local. So what is that? That's your property tax on your cars, real estate tax on your house. That is state and local taxes you pay when you do your income tax returns. So that's what most people are dealing with. And with the TCJA back in 2018, they dropped that down to $10,000. That's the max you could deduct. This one's a hot topic. This one there's going to be movement on. The current, and I've even seen something else on this, the stuff from my research software, it's saying that they've got that at 40. I've heard 30, so to be honest, I'm not 100% sure on that one. And I didn't really take the time to look it up because I think this one's going to move around some. This one's a big deal, especially in a lot of higher tax states. Think California, think New York, think places like that. This one's a big deal. And so I don't know what the new number is going to be. It's most likely going to be more than 10. I don't think we'll get all the way to unlimited like some want, but I would expect somewhere in that 30 to 50 range is where we end up. We'll have to pay attention to that one. I think 40 is probably a good bet, but I don't like to bet when it comes to taxes. I like to know what's going on, so we're going to watch on that, and I'll keep you informed. But SALT tax is definitely one that's in play. The other ones we can say, yeah, that's going to stay. This one's a hot topic. It's going to move, and so I'll keep you up to date. All right, next one is home mortgage interest debt. So currently we're set at $750,000 that we can use the interest for on our Schedule A to deduct when we itemize, but that includes your first and second mortgage. We're capped at $750,000. And home equity debt, just so you know, if it's not used for the house, think we did home equity to remodel the kitchen or something like that, it's not deductible at all. You can't take out a home equity right now and go buy a boat and get to deduct it. That's out. Currently, that's set to expire, and it would go up to $1 million. And you would be able to do that on the first 100,000 of home equity debt as well, regardless of what you used it for. I don't see this one going back. I think this one stays just like it is. This probably helps them claw back some money. I don't see this one going back to $1 million. I think this one's going to stay just where it is. So $750,000 cap, first and second, has to be used for acquisition debt or for the property. We'll get into details of that, but I don't see that one changing. That one's going to stay just like it is. I've been wrong before, but I think that's a pretty good bet. Well, this took a little longer than I had hoped, so I want to be respectful of your time. I'm going to go ahead and cut this short. I'll drop the second part in the next day or so. I'll put a link to it right here. You'll be able to get to that one here and catch the second half of this. You're going to want to do that because there's a lot of important stuff in there that some of it's even a lot bigger deal than what was in this first part. But the main thing I want to make sure we all understand as I wrap this up, and hopefully you found this useful, and if so, go ahead and subscribe. But the main thing I want to just make sure we all understand, this has not passed. This is not law. It still has to go through the Senate. It still has to get signed. Some things will change. And I will get you that once that occurs, and we'll go through it in much more detail and hit the stuff that really matters. Some of the stuff, we're just going to have to wait and see. So with that, like I said, be respectful of your time. See you here again on the next episode. Talk to you later.